Good evening. This is Ken at Tortoise Capital on February 5th, 2020. This is the follow-up conclusion video to the Tesla swing trade that we posted from February 3rd. In that one, I described how much I disbelieved in it, couldn't understand it, but nevertheless traded it. Went through some kind of analysis of the trader's challenge of balancing the need to follow rules and the need to be informed by judgment, so that getting that trade-off between discretionary and rules-based. I went through that in 3 or 4 minutes. So just as a recap, here was the trade narrative of the Tesla swing trade. So right around Thanksgiving, November 26th-ish, or 25th, 2019, Tesla broke out to like 360, a Z3 excursion, then started to fail back, so I got short. Was hoping for a return, or planning for a return to the Bollinger Band mean, which would have been about a 30% gain. It never failed through the dragon, and then started to resume. So the RL10 came back to the dragon and took off. So micro loss, and rack it up. It didn't follow through further, but it didn't fail beyond the Bollinger Band mean. So after an excursion, the reversion back to the mean is the least surprising thing. Volatility on the Z3 Bollinger Bands declined. MACD histogram went from an excursion into the summer, now into the fall, coming back through the Red River to the zero line, which is the MACD boundary between long side bias and short side bias in our swing trading strategy. And then instead of failing into the winter, it found support at the zero line and became the summer, and the Z3 pinch had occurred and got a Z2 breakout, so we bought it with about a $20 initial risk for position sizing at 358. Now you get this range expansion, pulls back in an orderly fashion, finds support at the RL90 and the belly of the dragon. Didn't come back to the Bollinger Band and took off, so you're starting to lock in gains here at the bottom of the dragon. Pulled back, didn't even get to the edge of the dragon, but resumed, so why not? Third position. Pulled back, found support in the dragon, resumed. I thought this was, if I thought it was crazy over here, I thought this was just stupid. So I didn't add a fourth position here, and it pulled back, found support at the dragon. Was tempted to pull the trigger here, but I was waiting to see a new all-time high. Well, got it the next day, it gapped up, so I just bought the fourth position with about a $50 stop. So now we got 4 positions in, and it never looks back. So in this point, I'm using yesterday's low to trail. Then the big 8% gap up, and then it runs all the way up to something like 970-ish or something like that. Very tempted to just pull the plug and get all out. At any time, if my stops are hit here, I'm all out of all those positions because I don't believe in any of them. Just trading what I see, though, according to the rules. The rules are clear, and they're smarter than me, so, 80% of my trading is rules-based. 20% is probably my discretion. I think that's a good start point for me to base my strategic choices on. At 80%, I can rely on improved, simplified rules, which are smart, and then 20% to respect the awareness and adapting to non-contiguous, non-linear changes, so I can add that much discretion. Any more discretion, and I'm starting to believe in my own judgment. I can just show you right here on Tesla how dumb I am. Any more than 80%, though, on the rules, and now I'm starting, I think, to undervalue the forward-looking, pattern-matching skills of the monkey mind. So 80-20 seems to me to be a reasonable trade-off for me, and I'm willing to live with that. Your mileage may vary, and you got to sort that out on yourself, and just make the decision for the trade-off and live with it, and then adapt it on the basis of evidence and risk management, which is a separate condition altogether, but related. How much money am I putting into each one of the transactions? If you're trading at a level of risk that you can afford a lot of learning, well, then you can really accumulate enough evidence with stable rule sets and then document those times when you're not using the rules but are supplementing it with discretion, and then you can study the value add or not of your discretion. So back to the story. So here it's sold off intraday. I was ready to just get everything out at 888, but because of the previous gap, I said, well, it might still resume. People might think that's a buy on dip opportunity. So we'll see. Up, but no, it gapped down, started taking off right away. Only got to yesterday's low and then started to sell off again, so that's where I just pulled the plug at 816 once it broke below the open today. So I'm out at everything at 816 on entries of 358, somewhere around 460 or 440, excuse me, 500-ish and 620-ish, and then all out at 816. And then this is where it closed the day, so that kind of looks like it splits the difference, gave it a chance to resume, didn't stick around later, and I have a real nice sense of closure on this one. So process the emotions. The emotion is relief, and gratitude, and forgiveness, and now I'm back into stalking, so I'm ready to go. Notice how high the MACD histogram, or the MACD signal line, had gotten to 118. This is a log scale. So this is deep in the summer, well above the Red River, and now if it comes back in the fall and then finds support in MACD, I'm ready to start regenerating this in the same way that I started the positions down here, lather, rinse, and repeat. So this is part of the TC 2000 bundle, where we've kind of coded out the monthly, weekly, and daily 4 seasons on rules on my standard stack of intraday and swing trading. The subset I just call the boot camp because I got about 30 choices on here that represents a wide variety of sectors, indexes, countries, currencies, specials at the mid-cap and large-cap individual companies that I've just developed skill and interest in because they have certain qualities as both swing trading and day trading good candidates. They have a lot of volatility, a lot of volume, tight bid-ask spread, and a wide range of portfolio choices. So something is always coming in and out of the season. So these are the ones that are on monthly charts on spring, and then I like weekly spring and weekly summer, then daily spring, summer, fall, and winter. These are the ones. What I like right now would be daily springs, because it feels like the market has been recovering. So my top choices for continuing those would be U.S. Steel. Love it. So I got short and had to cover that one today. Boeing is in the bottom of that stack, ready to go, and nice breakout. Walmart and natural gas, all looking pretty reasonable. So we got 2 positions in natural gas on the short side. My stop is now here, and that got hit today, so I'm out of that 2 scoops short. So it's the standard rule set on a set of targets that I've selected to give me the enough frequency and opportunities that I want, and the ones that I'm not watching I don't worry about. Can't carry them all anyway. And that's the story of Tesla. I just wanted, I made some updates to the way I'm doing the daily market health check. So just to make it a little easier to see the prices, which I'm using this bar. I found out when I got away from the candles and the colors on this, the reduction in noise, I didn't need that much information. It was distracting. So just thin, high, open, or open, high, low close is enough. It's trading right now at 332 in the market. Here's the 1-day range in yellow, so that's the 1-day high, the 1-day low. That tracks to this. This is the 10-day look-back period, so inside this price range, here's the 10-day high and the 10-day low. So there's those thick red and thick green lines have meaning because that 10-day trading range has meaning for me. Then the 30-day period is this 20-period, 30-period look-back to here. So from here over, here's the 30-day low, and that's very close to the 10-day low. So that just tells you how volatile the 10-day low is. It's almost a 5% move. And then this move, so now the high and low, the 1-day, 10-day, and 30-day lookbacks have meaning for me. The RL10, the RL30, the RL90, and the moving RL270, which for me is the long-term fair value of at 321. Then the MACD histogram simplified to give me the seasonality, so that the 0 line is for me, the signal line is here. It's above the 0 line, so I have a long bias, but it's in the fall because the slope is down and it's well below the Red River, so that's been a pullback of significant magnitude. Now if it holds here and takes off, that means this is going to keep going. It's testing all-time highs and 10 and 30-day highs. Off it could go, and long term, you know, I'm looking for these price points up in here as forecasted price moves going forward. So if it breaks out here, I'm looking for confirmation signals at like 333.50, which is above the RL10, the RL30 dip, the current RL30 or the Z3 extension, the highest Z3 extension. So back here on this day, it would have taken a price breakout above 338 to really be a Z3 breakout. So if it ever gets above here at any time in the future, that I know that on somebody's time frame, that will be an amazing Z3 3 sigma move. So I'd like to keep track of that. The current Z3, the bottom of the Z3 retraction, the Z2 splitting the difference, top of the dragon, spine of the dragon, belly of the dragon, the RL30 or the Bollinger Band mean, the SMA 30, the bottom excursion of the RL10, Z-1, long-term fair value, 10-day low, Z2, Z3. So these are price levels that give me different sorts of insights. So that's the new cleaner version, I hope. It'll probably still look busy to a lot of you, but it cleans it up a little bit easier, and I wanted to say that once for the record. So thanks for your kind attention.